And so this report from Fannie Mae, from the November 22 multifamily, it's titled Multifamily Market Commentary, looking at multifamily renovations from a small but stable part of construction activity. Obviously, most of construction in terms of multifamily is new development. That makes sense. You're spending a lot of money when you're building something, not always when you're fixing up some units and curing some deferred maintenance. But they make a couple interesting points that I wanted to note. First of all, just the risk profile of a renovation project rather than a ground-up development. And Fannie Mae makes it pretty clear that renovation projects tend to be recession-proof, and that oftentimes renovation financing is available in a recession, looking back at the last great financial crisis, but also that the results tend to be pretty positive in terms of a return standpoint. One interesting statistic, and again, this answers a question on some of these LinkedIn conversations of, all right, so how many units have been renovated over the last couple of decades? And according to Fannie Mae, about 21% of all apartments over the last 2 decades have had some degree of renovation. So we're about a fifth of all multifamily properties have been renovated, which is a decent amount, but it's certainly not, it's certainly far away from saying, all right, there are no classic units to renovate. Not to mention every year these units get wear and tear. Mm-hmm. Properties where it was popular to renovate property assets built in the 60s, 70s, and 80s. Now it's the 90s and early 2000s. Whereas 5 years ago, renovating a early 2000s property seemed kind of silly because it's like, well, it's kind of still new. Mm-hmm. But now you go into these early 2000s built property up to like 2008, 2009. And they really look like a B-class property, not an A-class property. Mm-hmm. They weren't putting as high of end finishes in the early mid 2000s. They don't look fresh. They don't look modern. They look like a B-class asset. So there's clearly an opportunity in the right market, the right demographics, to do a renovation project and bring those rents closer to market and make it look like close to a brand new asset. Because a lot of the aesthetic choices or the way that it was constructed is still modern. There's not a lot of physical obsolescence. It's just the finishes are out of date. So we've got a lot of new units that are just getting older every year that need renovation, but also a lot of classic units that have not been renovated either. We can see, I found this interesting, just the value add business plan has become more and more popular over the years, and this graph really gives us a good example of that. Really kind of after 2013, 2014, which the economy was really recovering after the great financial crisis. But you can see in the red is the renovations only. So obviously development picked up as well, but a lot more of just renovation only business plans. When we look at the previous cycle, this chart 2002 really through, it's called the great financial crisis, 2009 or so, it was a pretty small percentage of multifamily construction projects. Now, today, it's a much, much larger percentage of the overall construction. Now, when we were going through this report, Addison, I think the first thing that you asked about was the difference between the last couple of years and this last year, because we've seen two things happen. Costs have gone up, material and labor, as well as the fact that you didn't necessarily need to do a big renovation project to get the rent premium you were underwriting. Look at, okay, we're going to put in, call it, $10,000 per unit and hope to get a, $250 rent premium. Mm-hmm. Well, you could, then now the option is, you can, instead of putting $10,000 in, you have to put $15,000 in, and maybe you'll get more than the $250. Maybe you'll get like a $350 rent premium, which is great. Or you could put very little money in, maybe do a heavy turn, put in an LVT floor, or just clean a unit up and still get a $250 rent premium. So it's a pretty easy return calculation of, $0 if you're not putting anything into it, or call it $500 to $1,000 normal turn cost divided by 250 versus 15,000 divided by, 250. Mm-hmm. I mean, it's pretty easy. It's pretty easy math. Obviously, annualized 250.